Well, hello and welcome to One-to-One Mining Investment. Now we are going to have a mine finance focused panel, and I'm delighted to welcome our three panelists for this session. We have Kevin McElligott, who is Managing Director Australia for Franco-Nevada. We have Jan Fuchter, who is Director Project and Structured Finance at Export Finance Australia. And we have John Dorian, who is Investment Manager at Orion Resource Partners. John and Jan are in Sydney today, and Kevin is over in Perth, and I'm up in Hong Kong. So welcome, gentlemen, to the session. I just wanted to start things off. How has 2020 been for you? Are you still making investments? John, let's start with you.
Sure. Thanks, Leo. No, good to be here and good to chat to both the other guys on this panel. We're very active in the mine finance market, and generally we've been investing through all of 2020. We actually had our largest transaction to date in the US, buying a package of non-core assets from Occidental for about $1.33 billion. So that was a fantastic, I think, transaction for us for a number of reasons. We've been to investment committee here in Australia, so I mean the business has carried on as normal. I think bar the friction that's created by not necessarily being able to do as much meeting of management teams. Due diligence is kind of more interesting and requires more thought. How you get around some of the challenges there, but no, in terms of deploying capital and doing deals, it's very much business as usual for us.
The deal, the Occidental deal, what was the project?
So it was actually a package of royalties and land grants that there's a very interesting history to them, but Occidental effectively decided this was non-core and sold that package of royalties and land grants to Orion, which we financed through various means.
Fantastic. And Kevin, how's 2020 been for you guys? Obviously, gold has been on a tear.
Yeah, look, we're back in business gold-wise. I mean, if you go back before 2020, I think more of our investing was actually in the oil and gas space in the last couple of years. Prior to that, simply because that's where the opportunity was. But it's flipped around now. Obviously, oil and gas is on the nose. There's not a lot of money going into that area. And gold's on a run because prices are up and projects are moving ahead. I can list off 10 examples of stuff that's been sitting around for years and is now moving ahead. So we were pretty excited, especially at the start of the year. We thought with gold running, there'll be some great opportunities here, and there have been. The flip side of that is or the counter to that is it's been exceptionally competitive. There's so much money coming into the space that, although the opportunities are there, the pricing and the valuations and the competition to get involved is as heavy as it's ever been, really.
And Jan, how's your deal flow been?
Yeah, we're very busy looking at a lot of things across a range of commodities and in different parts of the world. I think I would agree with the views that John and Kevin put forward. We do see a lot of activity. Depending on the commodity, there's a lot of competitive tension. And I do also think it is a function of region. Certain regions, banks may be somewhat more hesitant. Other regions, banks continue to support the development of new projects. And we sort of see ourselves more as along the lines of bank lending as opposed to, say, Orion and Silver Wheaton in terms of the kind of funding that they provide. Some projects have been delayed, and that's really a function of COVID-19. Some of the projects that we were looking at the beginning of the year have been delayed, and that's really a function of people not being able to travel to sites. to conduct their due diligence and to progress the feasibility or the front end engineering of particular projects. As John indicated, it has resulted in taking a different approach. Another project we're working on, in fact, with some of John's colleagues, we undertook what we called a virtual site visit. So we normally have a requirement to visit site, but because we weren't able to get there, we participated in the virtual site visit. So people are taking a different approach to what they previously did, and things are certainly moving forward.
I mean, this is a big issue, this issue around due diligence and the ability of people to be able to visit sites. John and Kevin, have you taken part in any virtual site visits, or are the projects that you can invest in at the moment, do they necessarily have to be in jurisdictions where you have people on the ground, or trusted partners who can go and do the due diligence for you?
Okay, I'll go on that. Yeah, I think there is, I guess, certainly an openness to different methods of due diligence. I think there's a preference, obviously, for having your own personnel go to site, but where that's not possible, certainly having trusted parties who are available to go on site. Say in WA, I'm sure Kevin and I'm sure Jan have a number of trusted partners that they could call upon to go to site in those jurisdictions. I don't know about the idea of no one going to site. I think it's very important to a lot of investors to actually have that confirmation, particularly of an operating business with an operating management team. It would seem quite tough for me personally to get my head around not having had some form of interaction. But as Jan pointed out, virtual site tours are certainly one of the ways in which people are bridging the gap. I think fundamentally there's an appetite to continue doing business, and a realization that commodities is somewhat decoupled from many of the restrictions that have been put on other industries. Take airlines, for example. Commodities have actually performed quite well through this crisis in terms of businesses maintaining their business. So there's an appetite to continue doing deals, and I'm sure Kevin and Jan and myself and our businesses will continue to find ways to adapt.
Mm-hmm. I mean, given that the mining industry have a long sort of track record of focusing on health and safety, and the mines are in quite sort of remote locations, then there's obviously lots of space out of the mine site to ensure adequate social distancing. If you can, the challenge, I guess, is whether you can get in and out of the country. So it's easy enough to go and visit mines in WA maybe, but to actually, if you were going to go and look at a copper mine in Botswana or something, that might be more challenging.
Yeah, very much so. I mean, again, the due diligence site visits, big issue for us. There's no substitute for it. We have done some virtual site visits. I haven't been part of that. But I will say our guys are planning on traveling again. So we're making travel arrangements now. We'll wait and see. It has to be something good that gets us out of the office these days. We'll wait and see what happens with quarantines before and after, and how that all goes. But yeah.
I mean, what is the sort of, is there a maximum length of time you'll put up with quarantine for in order to go and visit a project?
I think it depends on the opportunity. It has to be a pretty serious, sizable opportunity where people will risk 2 weeks there and another 2 weeks when they come home.
Absolutely. Another issue that you guys raised in the opening statements was this sort of competition for projects at the moment and for funds. With the equity markets, the mining equity markets on a bit of a tear recently, and lots of money flowing into sort of equity capital fundraisings. How's it been for the sort of alternatives sector?
Well, I'll say people are still looking at the alternatives. No change there. If anything, we're doing as many term sheets, as many project reviews and as term sheets as ever before. But I think we're just surprised at how many other people are showing up at the table. There's sometimes where you show up and there's there's maybe 3 other people there. The last one that we just did, there were 10 bids. And I'm thinking to myself, I can't remember the last time there was 10 bids on a project.
No, second that. I think I'll second that from Orion's perspective. I think your bread and butter, straight down the line project financings are very, very competitive, particularly in gold. Kind of less so on the base side, but particularly in gold. And I think, from Orion's perspective, what that means is you need to be agile and you need to think, I guess, dynamically about what it is you can offer to the borrower. If you can think outside I can't think of a better cliche, but outside the box in terms of what you're actually offering to a counterparty, which is something I think we pride ourselves on, then that's really, I think, what our teams are focusing on, because I think, as Kevin pointed out, the sort of bread and butter, no-brainer financings are so highly competitive and really at margins that I just don't see us competing on.
What are some of the sort of outside the box things you can offer to sort of sweeten the deal, so to speak?
Well, I would say one element that people or that management teams often under account for is execution risk. And in this environment, we were involved in a process earlier in the year. You may have credit approved term sheets. You may have any form of approval from your traditional project finance lenders. And I think people need to think, or management teams should think long and hard about what that really represents in terms of execution certainty in this environment. We've heard of lenders not taking on new business. We've heard of lenders increasing due diligence requirements. So trying to educate borrowers as to what execution risk really represents, and the fact that we think we're more dynamic. We have to be, obviously, we're an alternative financier. We can help bridge that gap, and that's something I think we're very focused on.
Yeah, and on the project finance side of things, are the banks lending? I mean, is it gold that people are focusing on, or are you seeing lending across the full commodity suite?
Yeah, our observations, Leo, are that, as I indicated earlier, there is a lot of competitive tension. It is a function of the commodity. As John and Kevin indicated, when it comes to precious metals, there's a lot of interest. Base metals, I hear what John indicated, that perhaps not the same sort of competitive tension as with precious metals, but certainly we still see, and again, it is a function of regions and countries, but we certainly do see the commercial market having appetite for base metals. The number of, for instance, copper bulls. A lot of people still think that copper is going to play an important part of renewable energy projects, of electric vehicles, and the like. But I think what we're also seeing quite a bit of where we're seeing a lot of activity is, and certainly I speak on our behalf, is in terms of critical minerals. A number of governments around the world have identified critical minerals as being key to a number of emerging technologies, and particularly where they're required for things like wind turbines and electric vehicles. And so I think you'll see a lot of particularly government agencies like ourselves increasingly focused on the financing of critical minerals. It can be argued it is a lot more challenging for a whole host of reasons and obvious ones. As an example, the commodities tend to be the markets for those commodities tend to be opaque, and so pricing becomes an issue, and supply and demand. But given the importance that a number of governments on those commodities, I think we will see an increasing amount of activity in those particular commodities.
Absolutely. Has the sort of disruption of supply chains by sort of the COVID restrictions, plus the sort of China-America trade war tensions, has that led lots of people to sort of think, well, we need to secure our own domestic supplies of critical minerals?
Well, my observations are that you raise the point of supply chain risk. I think with concentration of supply from one particular area or one particular country. I think what COVID-19 has highlighted is that it has highlighted the risk on that supply chain, and I think that also ties in with the critical mineral strategy of the European Union, of the US, of India, and other countries. And so I think there is an increasing focus by governments on the risks that exposes a number of sectors to. So whereas it's not something that we focus on specifically in terms of our assessment or our analysis, I think on the periphery and something that other people think more in more detail, that is certainly something that has come to the fore recently.
So 2020 has been a pretty strong year for mine financings so far. As we go further into the year and into 2021, what's your sort of outlook on the state of the debt finance, the mine finance market? John?
Well, look, I see positive, especially on the gold side. We've got a backlog of projects to get through right now. It's like there's been a re-rating, and the bar's moved on to what's economic. So that's we're just continuing to push through those, I think, and I don't see any end in sight, because just as you finish up a review of one project and you think, oh, I've got a break now, that within hours you've got the next one going. So haven't had a break in a while.
There's plenty more to go. John, what do you think?
I think I would suspect that as long as gold remains where it is, gold will be highly competitive, and I'm sure we'll see a lot of projects continue to be dusted off. On the base side, I think you probably need some more. I think you probably need a few more quarters of prices at these levels, really, to unlock a number of the financings that probably have been stalled for some time or need to be revisited. I'm not sure there's the same level of excitement and confidence in the base metals market that there is in gold. But give it a few more quarters, I'm sure that will spring into life as well.
I mean, iron ore's had a tremendous year so far, hasn't it? I mean,
yeah, but for I would say probably specific reasons to iron ore. I think that's been a surprise to a lot of people. But certainly on the base side, it's zinc has not been long out of the sub $1. Copper's been was very briefly at $3. I think it requires a bit more for people to get the same levels of excitement as I'm sure Kevin's experiencing in the gold side.
Absolutely. Yeah, and what do you think going forward, looking into 2020? Plenty more deals to come?
Yeah, we're seeing a lot of things come across our desks, both in Australia as well as overseas. I'm no economist, but people do talk about a link between low interest rates and a continued strength in commodities. And then, and again, it is specific, and this is one of the reasons why I'm very keen on projects, is that if you look at the supply becoming available for copper, with grades declining in various copper regions around the world, I think that bodes well for a number of commodities, and with the importance of some exotic or other commodities, if we call them, that don't get sold into a terminal market. It'll be interesting to see how potential lenders will respond to proponents wanting to develop those kind of projects.
Absolutely. With sort of government spending at sort of record levels, and corporate debt being sort of drawn down around the world, everyone's tapping into their debt facilities at the moment. Is there any concern about over leverage going forward, and then an eventual tightening in the debt capital markets?
Oh, who wants to address that? I don't know. It's I don't see a concern about over leverage right now. It's more a concern about, especially on the government stimulus packages and the debt and deficits that are piling up, is right now people are just worried about getting through the pandemic, waiting for treatments and vaccines. But then the next thing after that's going to be, okay, how do we pay this back? So there's not much talk of that.
No, Jan, the banks you're talking to, are there any concerns about eventually a credit bubble being created?
I don't have that sense. I think if anything, our experience is that banks are cautious. And again, we don't follow that too closely, but certainly I think if our observations are correct, then I think a more cautious approach by banks is one of the mechanisms they are employing to protect themselves from over leveraging.
Mm-hmm. Absolutely. And John, on your side, what's your take on the outlook for the debt capital markets?
I think there's an enormous pool of private capital that has yet to be even nearly deployed. I don't foresee that there'll be any shortage of capital for almost any sector for quite some time, and that's frankly a product of negative real rates around the world. There's an enormous amount of money seeking a return, so wherever that is offered, the money will flood.
And do you think, when we get into the next sort of few rounds of sort of corporate reporting, when you get mining companies, particularly gold producers, reporting, decent, solid profits and paying dividends and things like that, when a lot of other industries are reporting, horrific losses, are we going to see a lot of generalist money, do you think, flowing into the mining sector?
God, you hope so, but we have a history of that on the gold side, don't we? We just lower the cutoff grades and drive up our costs, and that profit margin disappears after 6 months.
Do you think the industry's learned lessons from the last time, though? There haven't really been any of those sort of crazy M&As and things like that, and mega projects done this time. Have people learned their lesson, do you think?
You'd like to think so.
We'll wait and see.
There's actually a deal out. There's a deal out today. There's Northern Star and Saracen have just agreed a nil premium merger, and I think that's indicative of. I don't want to say lessons have been learned, but certainly there's a fair amount of DNA within companies now. If you look at the way Barrick's being run, that hopefully avoid some of the worst deals, but I think there's still a huge amount of appetite for deals. Mm-hmm. They're likely to be smarter. A nil premium merger is a perfect example of a smart deal, seeking synergies as opposed to paying an enormous cash premium with debt. So I think there will be lots more deals. We're certainly, that's a core pillar of our business, really, is supporting companies through acquisition financings, and that's a very busy part of our business. But probably fewer huge cash premiums being paid.
So still plenty of deals yet to come. Still plenty of time for people to mess things up, I guess. But for now, people seem to be, behaving very sort of conservatively, responsibly, and things are looking pretty bright in the mining industry.
Yeah.
Enjoy the time in the sun. Absolutely. Well,
thank you very much for your thoughts today. That's been very interesting, and look forward to seeing you live in the flesh when we're through this situation. But thank you very much, gentlemen.
Thanks, Leo.